Hi everyone, in this video we are going to start looking at accounts receivable. We are going to start analyzing the concepts of allowance for uncollectible accounts, what a bad debt expense is, and how we record revenue. So whenever there is a credit sale, the first thing we are going to do is we are going to record that credit sale as a debit entry under accounts receivable. So accounts receivable is going to increase revenue, or I should say retained earnings, is going to increase by the same amount by the time you have credit sales. When we record this at the same time, what we are going to do is we are going to assume a percent of sales is not going to be collected. So typically a percent of sales is not going to be collected. So we are going to record that under allowance for uncollectible accounts. And then we are going to record that as a bad debt expense. Next, what's going to happen is when we start collecting against our accounts receivable, so we are going to do collections. It's going to reduce our accounts receivable, and whenever we collect against our accounts receivable, we are going to receive cash, so our cash account is going to increase by the same amount. The last piece is write-offs. When we have write-offs, that's going to decrease our accounts receivable, and at the same time that's going to decrease our contra-asset account called allowance for uncollectible accounts as well. Now the intuition may tell you to actually write bad debt expense when there is a write-off, and as you see in accounting we don't do that. And the simple reason for that is you may make a credit sale, say at the end of December, right? And you won't know when those write-offs are going to come in, and you are going to close your books typically at the end of December. And the write-offs can come in the following year or even the year after that. So given that uncertainty, and given you need to close your books, accounting treatment goes as a forecasting. You record your bad debt expense as part of that credit sales. This is again a forecast. You record bad debt expense associated with these credit sales at the same time. And then as write-offs come in, you are going to reduce accounts receivable because you won't be able to collect them, and you are going to reduce the allowance for uncollectible accounts as well. That's the basic idea behind it. Not knowing when the write-offs will come in, and given the fact that write-offs will actually come in during the years following the credit sale, you need to treat the accounting in this manner. Forecast as a percent of credit sale, and then as the write-offs come in, you are going to record that as well. So this is kind of the basic idea. In the next video we are going to see how this is going to play out.